just disclaimer to get out of the way. Wook Capital Management Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from a professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any action you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results. All investment decisions of an individual remain the specific responsibility of that individual. So it's our second Wook in Review. We are going to be holding these weekly conversations Friday at the market close to just recap major events impacting financial markets in the preceding week. Even though I'm not a foreign exchange expert by any stretch of the imagination, I think it would have been remiss for us not to cover some of the significant moves in foreign exchange markets that occurred over the past week. So we're going to talk about the UK situation a bit and foreign exchange a little bit more broadly and kind of what the implications are. And this does dovetail a bit with last week's conversation about Fed policy. And what's going on, in this rate hiking cycle as we're in this global rate hiking cycle. So I have the newsletter on the right side of my screen. If you didn't sign up yet, the links for signing up are in the Wook Discord. If you're not yet in the Wook Discord, wook.gg will take you there and you can get in. Joe, just audio and video check. We're good?
Yeah, sounds great.
Okay, cool. So as I said, I live in Tampa, so it was a stressful past week for me. We were very fortunate in that the storm shifted further south than it had initially been at points anticipated. So, we have no power in the house, but our house is undamaged. And other than, I'm going to have to throw away a refrigerator full of food, there's no losses for us. But definitely thinking about folks in Southwest Florida. I've read that Lee County is going to have a month or more without power because their grid has been completely wiped off the face of the map. So it's just a good example of risk can happen fast. Risk can happen out of anywhere. Things change quickly in both the real world and also in financial markets. So with that said, we had some pretty big events that happened. We talked a little bit last Friday because the news had come out on last Friday about the new UK Prime Minister Liz Truss, her government's new tax cuts, their new approach to basically taking a page out of Reaganomics and trying to cut taxes for higher income individuals and also individuals across the spectrum. But what did that led to a lot of things that happened over the course of the last week in markets that I certainly was unaware of a lot of these things. And it just kind of goes to show you that where there's leverage, there's risk that can escalate and compound quite quickly. So the pound taking a beating is not unique to the UK. It's certainly been, sorry again, I'm trying to make do with my screen setup here, but the currencies really globally have been depreciating against the dollar over the past 6 to 9 months. I guess we're at the end of September now, so really 9 to 12 months. The pound in this graphic in the newsletter you see is looking back, to 2015. If you were to look at the all-time chart of the pound, this kind of decline looks even more stark. The pound made an all-time low against the dollar briefly, albeit the pound has rallied somewhat in the past week. So Bloomberg's odd lots team had sent out a few hours earlier. I just read this within the last 30 minutes because I've been driving. But I think this graphic here on the left side of my screen, you see from odd lots team kind of just a Bloomberg screenshot of the pound to US dollar rate over the last week. And you can see that on the 23rd, it was that the news came out of this new tax announcement, this giant tax cuts that this new UK government was looking to move forward with, and the pound began depreciating meaningfully, and during that time as well, the bonds, the UK gilts, began being UK debt. You can call it a gilt, you can call it a bond. It's interchangeable, but just FYI, when you hear gilt, it's just the UK's long dated debt. So the long dated UK debt also began selling off on the news of this, and really it led to kind of a ripple effect. So we had this huge tax cut package from that's going to cost 300 billion or so pounds, and 1/7 of GDP over 5 years. So pretty massive tax cut plan, the biggest in half a century. And the market reaction to that was selling off the bonds, selling off the currency, the view that investors need to be compensated for these higher risks now that the UK is a heavily indebted developed country that is now going to incur a significant uptick in debt over the next few years. And yeah, it led to kind of a chain of events that involved the Bank of England stepping in. So kind of scrolling through, we see the pound nosediving. We kind of, I guess I'll kind of separate the two topics a little bit. There's the specific UK stuff that's going on, and then there's the broader FX issues that are going on. So okay, let's talk about the UK specific part right now. So in the UK, right, they have more pensioners than we do stateside. Pensions are going to guarantee a payment to employees in retirement, and the pension funds need to manage realizing appropriate returns for the plan by investing in a variety of assets, bonds, equities, other. And I learned this week about these liability-driven investment products, which effectively you basically have these pensions leveraging up and buying long-dated bonds on leverage, and they are a primary participant in the long end of the UK gilt market. And once this news came out on Friday over the weekend, and then into Monday, as the pound was declining, as there were basically what ended up happening is it got caught into the selling kind of got into like a doom loop where these leveraged pension funds in these LDI products, we're basically having to sell the gilts. So as they sell the bonds, the bond price falls, the bond yield rises, which was kind of creating a reinforcing mechanism where if you see on the left side of my screen, the 10-year UK gilt, you can see that the yield rose in a span of, from Friday before the announcement, it was at 3.5%. By Wednesday, before the Bank of England stepped in, UK gilts had risen to almost 4.6%. So, 110 basis point move in not even 4 trading days. Pretty massive in the world of government debt. So this kind of doom loop that was happening where pension funds were needing to basically sell gilts to raise collateral to meet margin calls led to the Bank of England stepping in on Wednesday, and effectively the banks began quantitative easing, even though it was, as with most central banks globally, in the process of quantitative tightening. So it's not that the bank has shifted policy, but it was that the bank stepped in order to prevent a prospective crisis. It's obviously if you have pensioners, if you have pension plans imploding and pensioners, not receiving their pension checks, that has a lot of ripple effects throughout the economy. And the Bank of England, made the decision to intervene and to buy those gilts and stabilize the market. You can see through rates are still, of course, higher in the gilt market than they were before the plan was announced, but they've backed off of kind of that doom loop that it was in. So at least the Bank of England has indicated to market participants that it stands at the ready if this sort of thing were to come by. So that's sort of what happened in the UK. And there's several different better reads on the matter that I've looked at. Both Matt Levin wrote about it, I think it was yesterday, and there were several writers from the Financial Times, of course, that have been writing about it. But just the longer dated chart on the right hand side of the screen, you can see year to date, roughly, I guess from December, the change in UK bond yields. So the bonds have been getting sold off, and as the bonds get sold off, just like in the U.S. market, the yields rise. So you've got a pretty huge change from just 9-10 months ago in terms of the rate regime, and obviously that's really because late last year, I think all the central banks began to realize that what they had hoped was transitory is not proving to be so, and obviously then further interference happened with the Ukraine invasion and the continuation of COVID zero policy. So just a lot of bad news for creditors in that the value of the bonds that they've held continue to fall. The pension funds are not at, or were not at, immediate risk of insolvency, but obviously the uncertainty there kind of leads to self-fulfilling prophecy of sorts, and could have created that doom loop. So it's good BOE stepped in. It just kind of highlights that when there's hidden leverage in these products that don't necessarily, clearly not everyone understood. I certainly don't understand it. Most people that I've spoken with don't understand it. I'm sure there's plenty of smarter people out there who are welcome to chime in if they're not experts in the space and share their perception of the matter. But UK is definitely in trouble with all of this borrowing going on, and market bond vigilantes seemingly saying you're going to have to pay up in terms of paying us a higher yield in order to borrow. So it's not just the UK, right? On the right hand side of the screen, I just pulled from Koifin some of the year to date US dollar versus both Australian, New Zealand dollar, euro, and the pound. On the this global yield matrix, you can see other currencies that I didn't chart, but obviously the yen has depreciated the most year to date of those currencies listed. The what's that, Swedish krona also depreciated significantly. All of these currencies have depreciated against the dollar due to the Fed's policy shift, and now that we're in this rate hiking regime, so the dollar keeps strengthening. And the point kind of pasted here from a Chicago Booth finance professor is that many countries have not been through a cycle of much higher interest rates since the 1990s, and there's a lot of debt out there augmented by the borrowing in the pandemic. It's not going to be contained as stress in emerging markets widen. And thinking about the UK, right, the last time they did this policy, I think their debt to GDP was something like 40%, whereas now it's over 100%. So not just the UK, but other countries out there have become largely more indebted. And now as interest rates rise, the cost to service that debt rises. And it's certainly a very real risk in some of these emerging and frontier economies as their currencies are being depreciated, as they're trying to fight inflation, and as some of them are importers of both food and fuel that's often priced in US dollars. There's definitely been significant revisions downward in global growth estimates and forecasts from folks like IMF, World Bank, you name it. They've they've marked things down, and I think we're kind of at right this UK event this week was kind of like a first crisis like central bank intervention. Right, we haven't necessarily had many of those in the last very recent time, but it certainly feels like the world's getting into very shaky waters again with the dollar just acting as a wrecking ball on this moon mission. So we included the link about People's Bank of China working to make it more costly to bet against the yuan. And yeah, it just gets back to risk happens fast. So we included this graphic of how the front month volatility that's priced in the pound dollar mooned. It went from like 12%, which was already elevated versus what it had been in the preceding year, but it almost doubled in the span of just a few days. So all of that, if you're trading, if you're a company that engages in trade, like obviously European stocks are now at like 2012 levels of valuation relative to the rest of the world, or at least US stocks. So as the dollar continues to appreciate, there's certainly downside risk further in some of those equities. But the question then becomes, what is, like is there going to be a mean reversion back? How far does it go before it snaps back, right? And all of this is something that people can position themselves for in the short term. From like a long-term investment thesis perspective, it should be relatively immaterial to one's thinking. But obviously, if there's solvency issues and crises happen, right, and this, as I kind of led in with, things can change very quickly. So it's certainly important to stay abreast of and on top of these events as they're happening, and try and understand what the implications are for both you personally and your investment portfolio. So from the prepared material, yeah, I think that kind of wraps it. That there's definitely just a lot of folks out there who see increased risks in the market. Obviously, the volatility index. This graphic was just dollar pound volatility. If we were to look at, say, just the VIX is, I believe it closed above 30, but it's up meaningfully. Obviously, on a year-to-date measure, we can see as a percent. I'd rather it not be in percent, but making do. But yeah, so volatility's up. The Bank of England had to intervene to stave off this this threat of a domino effect of margin calls and prospective liquidations in the pension space, and that's possibly just foreshadowing more to come with more risk. In other markets, especially these countries that are buying food, they're buying fuel, they're importing all of that. Think about, we had Arab Spring, and I think food costs are actually higher now in some of countries that had Arab Spring because of those same issues, right? There's Sri Lanka. There's already been breakdown in government in Sri Lanka. So I'm not saying that there's going to be a global crisis, but this is certainly something to monitor. And when you see a top 10 global currency making moves like this, and seeing the market kind of unwind like this, and the central bank have to step in like this, it's definitely worrisome. So we definitely see that risks out there are elevated. Risks to the economic downside are elevated. And when you think about like what are risks to the upside, you try to think about that, and it's it's really stuff like it's tough to talk about Russia now, because we have a speech that President Putin had today, his airing of grievances and hatred of the West. It does not seem that there will be an imminent peace accord in Ukraine, so that leaves the European energy situation still challenged, and likely means these trends toward dollar strength, which again, it tends to end in crisis, is what the Morgan Stanley U.S. chief equity strategist views. So So that kind of wraps in the prepared remarks from the write up. Again, I would welcome folks who want to chime in or ask questions. I think we're going to run. Last week we ran about 2 hours. I think this week we'll probably run about an hour. So maybe till about 5 o'clock Eastern. Again, I apologize if I'm a little all over the place. I just got to this hotel a little while ago and haven't really had a chance to get myself caught up. I don't even know if anything else happened this afternoon that I missed, but I hope that is a decent synopsis of what's going on in both foreign exchange space and specifically in the UK. So Joe, I'll pause there.
Great, thanks, Rod. How you holding up? So you're in a hotel now, right? And how long you think you're gonna stay there until you guys return home?
We booked 2 nights, and so I have have my little Universal Express Pass for when Universal opens up tomorrow. Staying in one of their properties. We'd gotten annual passes last October, so they were coming up on the last few weeks that we could even use them. And the idea was, yeah, there's power in Orlando. It's an hour 15 up the road. Let's go up there and get out of this house that we've been stuck in with hurricane shutters and no power. And it's gotten a lot warmer today, and it was nice yesterday. The weather was cool, but today it's gotten back up into the 80s. So sitting in that house was getting uncomfortable by the time we got out of there this afternoon.
Yeah, that's actually not a bad idea. Get out, little mini vacation. Sure beats being home right now. Alpha Hound, I've thrown you up here. You requested to be a speaker, so go ahead.
Yeah. Rod, glad to hear that you're doing okay. Hope everything back home when you get there is, at least minimally in order. Um, I'm just going to stir the pot a little bit, right? Because I know I'm pretty bearish at the moment, and in some of our exchanges in Discord the last couple of days, you're looking for a rally to try and put some more puts back on. Do you see that manifesting? How would you see that manifesting? Obviously, we just talked about the Russia situation not really providing any relief in the near term, but is there anything out there that you see being a positive catalyst, possibly just the technical positioning of the market being, technically oversold and put call positioning being at relative extremes?
Yeah, that's more so it. So obviously, I had noted I personally, completely unrelated to Wook's investment portfolio, but personally, I'd closed out my Apple, my IWM, my QQQ puts and put spreads all earlier this week. So I had almost a high single digit percent positioning in those combined. So that's all sitting now in cash. I did buy a little bit of British American Tobacco yesterday and Dole yesterday personally. But in terms of like why I think that the next step isn't equities simply falling off a cliff. Look, I do think I'm with you. I'm pretty bearish. I think that over the intermediate term, the path is down. Whether intermediate to me is measured in months, plural. I think when I think short term, I'm thinking days, weeks. When I think long term, of course, I'm thinking years, plural. Like short term, the thinking is it's very oversold technically. Everyone, I mean, clearly not everyone, but you look at different data points out there on like futures positioning. You said put call. I mean, it's pretty bearish out there at the index level, and obviously this is more of an index level discussion rather than any single name. So that's kind of my thinking is like volatility, is pretty darn elevated. I mean, it's around 30. I don't know what it closed at. Feel free to correct me. So I feel like volatility actually will take a little bit of a breather, and there'll be a little bit of a rally before more down. Could be wrong, right? It could, there could be a Lehman moment. I had thought that the BOE stepping in would actually ignite more of a risk on or at least less of a risk off sentiment than it seems the balance of the week showed. So I'm certainly wrong there on that viewpoint. Yeah, I think we're hearing the speakers on the Fed side of things still imbue fear that they're going to stick with what they've shown us. Right? We talked last week about the summary of economic projections. You obviously see a lot of people that are more bullishly oriented talking about how many inflation measures are rolling over when you look at things on more of a coincident and or forward looking rather than backward looking basis. Right? We talked about how like they're looking at PCE and CPI, which are inherently looking backwards. And we talked about how rents, month to month rents are rolling over. You look at like the what is it, Freightos, some of the different shipping indices are way down. I saw some commentary from Maersk's CEO talking about not necessarily expecting a hard landing, at least from his vantage point. And Maersk obviously operates a huge fleet of both sea-based shipping and on-land logistics. So yeah, it goes back to like the reality that we're in this weird world where things are very highly correlated. Central bank policy seems to be steering the ship. My thinking is the Fed is obviously intent on ensuring that people perceive that they're serious about getting inflation under control. And I saw the University of Michigan sentiment data out this morning showed that at least longer term inflation expectations, I think, what is it, 5-year, is still, it was actually ticked down a tenth. So what is it, 2.7 is the expectation. So like those things are still good, that inflation expectations aren't untethered. But if the Fed is really going to stick to its word that it's going to wait to see trailing data show that it's succeeded in its mission, by the time we get there, it will probably be a point of it's too late for them to stop the crash. By the crash, I mean the real economy has obviously slowed. The preceding two readings, you're seeing a lot more layoff notices or hiring freezes. I mean, the news continues to come in. And unfortunately, though, the labor market data that the Fed's looking at is still, I think, so strong, and the readings have kind of held up, which makes it difficult for them to even entertain that pivot. So, yeah, I guess it's like a cluster of thinking and a lot of different points that I just threw out there. I know it doesn't precisely answer your stirring the pot, but yeah, that's some of what I'm thinking. And Joe or Han or Alpha, if you want to respond to that, by all means, or anyone who wants to chime in.
Yeah, I'm actually close friends with two individuals that are staffers in the tech space, specifically to San Francisco, and they've been dealing with a lot of layoffs and not much hiring. And the thing that's tough is these people that are laid off are following up with them like, hey, if you could help me find a job, and they have to respond to them. Yeah, not only you're laid off, there's not really that many people hiring right now. So super tough situation. You obviously feel for all these people. But a lot of these tech companies have, experienced bloat in the last few years. So it was only really a matter of time.
Yeah, I mean, I work for a major employer in New York, and we're unofficially in a hiring freeze. I think the news came out, whether it was today or yesterday, I forget, that Meta is unofficially in a hiring freeze. I think unofficially they had put a pause on a couple of weeks ago, but that's now company policy. Just a brief thing on the gilts, because it's something that I read in the press release that I haven't really seen talked very much about, right? The Bank of England still plans on selling down their gilt balance by the end of October, right? So like while they stepped in as a buyer of last resort to stabilize the market, it would look like yields for long dated gilts are still going to be going up through year end and into 2023. Right, so like part of my bearishness here isn't just like, hey, I think the sensationalized potential for a pivot there was way overplayed, and hence, right, like you've seen now the last 2 days, long duration assets have sold off. Bonds not down to the low that they were at Tuesday, but stocks certainly. But right, you're going to see long dated yields continue to rise. The Fed, right, not yet a net seller of bonds, right? They're just letting things roll off. But eventually, sometime in 2023, they're going to start actually unwinding their treasuries and potentially their MBS holdings as well. So, I kind of agree that there is still potential on the time frame of days to weeks, maybe even a month, where you could see kind of a technical bounce in stocks. But as like even just a near intermediate term, I really don't see how any long duration asset could go up from here and not substantially decline. There's a pretty good analysis, I think it was the Last Bear Standing Twitter account put out this morning, right, about like just how much the underlying cash flows changed when you have that change in rates specific to the gilt market. And it's pretty incredible, right? The duration went from something like 35 years to 10 years or something like that, right? It really massively swayed the value of those assets. And that's going to be the norm until there's a major change in Fed policy.
Yeah, I mean, I guess the analogy would be, the Fed forced everyone, through QE over the last decade to like really take on a lot of risk. And thinking about people who had to buy fixed income, obviously bond prices continued on. I guess this was the end of that 40-year bond bull market that seems to now be over and done with, right? And now the repercussions are, yeah, you bought a lot of bonds that are now worth a lot less than when you bought them. And if that trend continues, what are the impacts to things like pensions? What are the impacts to, for individual investors? If you're in like a 60-40 portfolio, you've certainly taken it on the chin, and to your point, are probably going to continue to take it on the chin. It's like trying to look at like what are the real upside scenarios. You could see if China. I saw news that China was going to start. I don't know if it was importing one of the Western vaccines or precisely what it was, but like China getting out of COVID zero obviously would be constructive for the global economy. If something happened favorably, if there were a coup, say, in Russia that deposed the despot in charge there, that would be constructive, I think, assuming that no nukes went off. But then you look like stateside, the Fed, obviously, it's really worrisome when the biggest bull case that I hear from people is like this idea of the Fed pivot. And it certainly doesn't seem like it's in the cards imminently. Obviously, these things change rapidly and can change. And it's like we talked about last week, the Fed is simply going to act on, the best available information that it has. And it's obviously trying to message something. And I'm sure that it understands and is aware of what's happening in the world, right? They mentioned explicitly that they, not that they formally coordinate with the other central banks, but they're certainly in contact with, aware of what other central banks are seeing and hearing in their countries. So, it could be the case that we get these last couple hikes in, and if something doesn't break, that's the big if, right? If we're obviously seeing these breakages. This week's discussion being about a breakage, right, in the UK. So there will probably be more things that break along the way. Will they be so systematic or important that the Fed or other central banks have to either intervene or change their stance? That remains to be seen. But I kind of agree with you that the bull case, aside from the kind of other geopolitical things I mentioned, is the idea that it gets so bad that the Fed can't make it worse and has to stop making it worse. And that's not a good scenario to be in. But to your point about like long duration assets, I mean, yeah, if risk-free rates continue to rise, inherently those long dated cash flows that are already fairly uncertain have to be valued at even less. And you would think that eventually there starts to be more of a bid on value, stuff that is really generating real cash flows. And whether, I know earlier this year, and I haven't looked recently, there was if you looked at like say just dividend payers, high dividend payers had significantly outperformed the underlying index, and not that high dividend yield companies are the only ones that are generating cash, but of course that likely means they are generating enough cash that they can service the dividend and hopefully their debt and invest in their business. But if you're a all in tech bro, to me your real hope here is that you get that hopeful pivot, and that's worrisome if that's kind of what you're betting on. Now, obviously, again, you're talking multiple years if you truly have done your due diligence and believe deeply in that particular individual equity or whatever that you've invested in, and that's a little bit different, right? We're more so talking about the indices, but yeah, I think from an index level, again, you just like look at sorry, let me just like pull the cues. It's when you look at that max chart, right? Obviously, you have .com bubble in 2000, late 99, early 2000, and then when you look at what the Qs did in the last 3 years, you had last time we had the Fed right raising in fourth quarter of 2018, you had the tantrum. Prices drew down, and then Powell blinked, and then really since then it was getting into 2020 and COVID, and then like the Qs are down 30-ish% year to date now, 33% year to date, and yet when you look at that max chart, it's still significantly above, it's more than 10% above the pre-COVID peak, which just on a valuation basis is, I don't even know what the price to earnings for the Qs are, but gets back to the conversation that's been getting had broadly of, well, if you look at things like price to earnings, one of my favorite is Yardeni. They put out free research on a regular basis, so like I'll just pull his up on my screen. So we're looking at 2023 235 estimate for the SPY, and you think about earnings, right? Corporate earnings, in the long run are going to be the thing that should drive these asset prices, right? If your earnings go up, your price should go up. If your earnings go down, your price should go down over multiple years. Obviously, in shorter durations, things like flows and things like technical positioning and sentiment and all that have much more of a weight. But just like looking at this graphic here of what is this? I don't want revenue. I want not. Well, we've got a couple things like operating margins, profit margins, basically were at record levels, and it's like, are consumers going to be able to keep absorbing both price increases? It doesn't seem to me that those operating margins at historical levels can expand further from there, which then, looking at the actual operating earnings per share, you're still way above the 23 estimate, and even 22 estimates are still just way above pre-COVID levels. And it's like the real economy didn't grow massively. Obviously from 2017, like post-tax cut shift, that's a little noise from Trump era tax cuts, but like you look at earnings per share, and this moon mission that happened in 2021, right? That was a chunk of fiscal spending that is not, that we talked last week about, like the Inflation Reduction Act and the infrastructure bill, like, and could there be another fiscal bill that were to get passed from this Congress? Obviously, I guess what I'm trying to say is that earnings, to me, just these estimates still seem way too high. Even if there's a soft landing, they seem way too high. And I think that once those start getting cut more rapidly, to your point, Alpha, that may, as we get into year end, as there's tax loss selling in the month of November, December, as different institutional investors may get forced out, right? They may, if your performance was so poor that you're getting tapped on the shoulder and we're closing up shop, there may be a lot of selling into year end that it could be just realigning, things. Like you look at like the PE doesn't look egregious when you think about how crazy high the E still is. And again, I'm just looking at yardandE.com's. They're just pulling data from Refinitiv and S&P, so this data is freely available. But they're like, okay, forward S&P is only at what are they saying? 16x earnings. Well, that is historically fairly high. It's not egregious. It's not crazy high. But then when that E starts to drop, I think is when things really will look bad. And it's really when you just look at these charts and you say, these companies are still at the index level, again, way above pre-COVID levels. We could talk about individual companies if we wanted to, but like S&P, again, just still more than almost 10% still above pre-COVID peak, which if you ask me, pre-COVID peak was quite an egregiously overvalued point in time. People can of course disagree with that, but I think that unfortunately there's been this investor behavior, right, that got ingrained over the last 15 years that you have to be buying, you have to be all in, otherwise you're going to get left behind. And like we talked about last week, cash is a real position. You can get a yield on cash now. You can get a risk-free yield on cash. FDIC insured bank accounts north of 3% now. And if you want to, tie up even a little bit of duration, you can get to 4% and beyond. So, given that is the hurdle that people have to clear, right? If the 2-year treasury is at 4%, let's call it, and you can get risk-free 4%, then you've got an equity risk premium above that, and it's like, what are you going to get? Are you going to be buying high risk assets in that regime? Probably not. So yeah, sorry, a little all over the place there, but hopefully that's helpful.
I think we'll invite some speakers to come up. It's been about 48 minutes now, and I think we're going to go for about an hour, so 12 or so more minutes. If anyone has any thoughts on UK bonds, the US dollar, or anything macroeconomics, or any questions you'd like to ask, feel free to request to be a speaker, and I'll throw you up here. All right, I actually have a question for you, Alpha Hound, if you're still here.
Yeah, what's up?
So living in, the Big Apple, have you seen a shift in sentiment when you go out and you see people? Do you see anyone's more tense? Like, what's your experience like?
I don't think it would be representative of anything happening in the markets. Like New York is a playground for adults, like, as a general description. And I don't go into the office, right? So I don't know, generally speaking, how people there are. Most folks that are out and about in the city are out because they want to enjoy themselves, and that really hasn't changed, at least since things have reopened post-COVID.
Yeah, that totally makes sense. I mean, I just remember as the GameStop frenzy went down last year, how intense it was and how like it was incredibly stressful for those that participated in any way. But yet when I would, go outside and I would go hang out with people, it's just completely disaffected everyone else. So I can see that kind of live even in New York City. It's a bit of a bubble. I think people can distance themselves well when they go out, and like you said, they're just out to enjoy the day. So
yeah, I mean, when I talk to my friends and colleagues that are markets oriented, there is a general sense that things will get worse before they get better.
Mm-hmm.
But it's not a it's not really a mood killer, right? I think most
Yeah.
people that view things professionally, it is what it is, right? The market is what it is, and you have to trade it for what it is, not what you would like it to be. Like personally, I did the rounds with some of my friends and family that are nearing retirement age saying like, hey, you might want to raise more cash if you haven't really considered that yet, because the risks of something major breaking here are, way heightened compared to the many years that you've been saving for retirement, and the timing here could potentially not work out very well.
Yeah. No, that makes sense. In regards to foreign exchange, I personally deal with this a little bit because I do e-commerce and I source my products overseas. Specifically, Poland is like my biggest. I have a partner in Poland, so I deal with them a lot. And essentially, when I started the operation 2 years ago, the Polish currency was worth about 30 cents to the US dollar, and now it's at about 20 cents. So it's not biggest drop in the world imaginable. It's nothing like a Turkish lira, but I'm definitely making more now than I did several years ago without significantly raising my prices. And my supplier has a few times. He's actually gone up a few times, but I'm still making more money than I was, which is nice. But obviously a bit unjust to him. So we might be transitioning to using euros when I deal with him, just to make it a little more stable.
Yeah, I mean, like a 30% swing in value there is still substantial for a currency. And Rod, I don't know if you touched on it exactly when you were explaining the gilt situation, but it's really a feature of the dollar's role as a reserve currency. The pound is also a reserve currency, but the UK share of global trade is just so much smaller than things denominated in dollar. I think it's like dollar reserves account for something like 48% of all currency reserves globally. The US economy probably accounts for about 20% of production and consumption, whereas in the UK it's like, I want to say it's like 8 and 5% respectively, or something like that, perhaps even a little bit less. Maybe it's 5 and 3%. But because you have so much trade denominated in dollars, that also means you have so much debt denominated in dollars. So when the Fed raises interest rates, that's effectively increasing the interest rate on debt globally, right? Not just all of the treasury debt that's out there. And it's also then going to decimate the collateral of any foreign denominated debt that's been posted against it. So if you think about like global money dealing, where you have sovereign debt being used to issue loans and create credit throughout the global economy, the building block of all of that really gets back to the 10-year treasury. And any increase on that really makes all these other currencies kind of captive to Federal Reserve policy, right? Whether it's the gilt or, I don't know what the Polish currency is.
Polish is the zloty.
Zloty, yeah. It's a systematic effect that has really, been to the benefit of the U.S. It's why we've been able to finance these huge deficits, regardless of whether the government uses money productively or not. There's always appetite to buy U.S. debt because you need U.S. debt and U.S. denominated assets to do trade globally. But when we change course and the dollar is not just marching downward for 15, 20 years, it's a global pain trade. And, it's not likely to reverse anytime soon, at least until inflation is under control.
Yeah, I think it's also very interesting to note, like, this Morgan Stanley's untenable situation. Every 1% change in the dollar index has a negative 0.5% impact on profits for international companies. You think like these companies such as Apple that are sitting on a boatload of cash, like US dollar, you'd think this would be very good for them. But it isn't if they're, getting a lot of money overseas and doing a lot of international business. I think Apple's largely US. I know so many people that are in Europe and they don't really use an iPhone and it's more Android over there, but still, I think a lot of sales do come from international. So maybe we have to see some prices increase.
40 some odd percent of Apple's revenue comes from overseas.
Yeah.
Right, so you figure it's a double whammy, because if you live in a country that has 10+% inflation, it's running hotter than it is here. Your disposable income to buy a new iPhone is much lower, And then if you're Apple, right, so you're going to see sales fall, but you're also going to then be accepting currency that is worth less when you try to bring it back to the United States. So it's I don't think reflected in the price of Apple.
China, Europe, and Japan combined for more than US in Apple contribution. Yeah, it's like 40% is America's. So it's they're definitely not immune to it, although they've seemingly until recently been the bid of last resort. And I think part of that's been like people fleeing for relative safety, like the view that something like Apple, this great company, which it is, just like a Costco, right? These are great businesses, great business models, and they've created incredible wealth for many people, but there's not just they're not immune, right? They're still selling 50-ish% of their revenue is still from smartphone sales, and they're going to be facing those real challenges of both on the cost side and on the currency side. And when you look at the valuations, and I think Apple's free cash flow yield is below the risk-free yield now, right? Like Apple's, you're paying more for Apple free cash flow. Obviously, you're getting equity in that case rather than debt, but like it just seems very disjointed from the underlying reality to me. And like when you look at the Apple chart, it's astounding how much higher it is than pre-COVID. And obviously they reported this week that Bloomberg reported that Apple's going to maintain a sequential flat in terms of iPhone production. They had thought they might raise, I think it was 7%, and they backed off from that. And obviously, depending on who you are and how you feel about it, you say, oh, well, the Pro sales are going gangbusters. Great. Well, they didn't raise the price of it. And I'm not sure that margins are expanding. I'm not an Apple expert, but again, I know they've raised price on the phone in some foreign markets, thinking it back to currency. So, I could see Apple in the double digits, and it would not at all surprise me within the next 6 months.
Yeah, I mean, I think you hit the nail on the head with the relative safety trade. It takes a long time to change investor behavior. It takes a long time to change consumer behavior, right? So in the same way that the effect of higher interest rates hasn't really fully propagated throughout the economy, right? And like we're just now seeing rents cool off. Real estate prices probably still have a long way to come down. It's the same sort of thing with investor behavior. And you see this at the end of every bull market, right? The leading companies on the cycle up are the last ones to go down, in part because people say, hey, Apple's a great company and now it's on sale, and all these other shitcos I owned are now like 80% off their highs, but Apple's still holding in there. Apple's probably the thing I need to own. And the idea that, hey, like this could actually be a secular bear market and the safest place to be is in a higher cash allocation. That's something that's generally not learned or embraced by enough investors until we're pretty close to the bottom, right? Because that is sort of by definition then the act that creates the bottom and gives rise to the next bull market.
I was reading Psychology of Money last night, and it's a fantastic read. I'm only halfway through it.
Oh yeah, no, I really like that one.
It makes me think about what Morgan Housel had to say about how important your own lived experience is in your worldview of finances. And I think, Alpha, you and I, we basically, anyone younger than us doesn't really have and you and I weren't even in the labor force. We were in undergrad when the GFC hit. But thinking about anyone who's younger than their early 30s has no idea of what a crisis, of what a true like bear market is. And their entire existence has been shaped by only up. And, excess risk taking is rewarded. And I in the different discords, I think a lot of the people in their 20s seem to think like, that only up is the way that it is. And then if you kind of look back at history, there's periods of time where you can have decades of these indices basically being flat from point to point. And that's why I say earnings growth is what, in the long run, these things will be based off of. What multiple you apply to those earnings, of course, will vary. But yeah, it's I think it's going to be tough times ahead for people who maybe don't have the fear of and haven't lived that experience of seeing something go to zero on them or completely crash on them. Obviously, again, everyone's experience is different, but that just reminded me of that. Definitely the sense I get still from talking to younger investors and traders is, this idea that, they'll pivot, they're not going to let it go down because they haven't, right, for the time that they've been in the markets, and that power of trying to break away and not just say, okay, my lived experience isn't the only thing that matters. There's a lot more to it. It's hard to do. It's easier said than done.
Yeah, no,
And
I think you're absolutely right.
Yeah. Sorry, I know
Go
we
ahead.
brought up,
Yeah.
we brought up Big Boek, and he's been patiently waiting to chime in. So please go right ahead, sir. You're on mute, by the way. Oh, there you go.
Yeah, sorry. Hi guys. Listen, I have a question regarding the China market, because it's been already a while since there is no major news, basically what I see. But we know all the stories, Evergrande and other companies in China that basically were going bankrupt or bust or whatever. So how tight are the markets, or what impact has China in terms of money or, I don't know, assets on the US market? I mean, how they correlate in terms of if one fails, another will fail for sure, and something like that. I mean, in terms of how tight are their financial, basically, relationship, so to say.
Let me take a stab at that. A couple thoughts. There is a very real tight relationship between the U.S. and China in terms of Chinese manufacturing of goods is still a primary trade partner with the U.S. So if China is not doing well, it doesn't bode well for the U.S. and vice versa. And just thinking about investors, though, there is a distinction I would draw between if you're an onshore China investor versus if you're an offshore investor. It seems clear to me that the Chinese Communist Party doesn't really care much about international investors when it comes to, say, like dollar denominated debt for Evergrande. Again, I could be off base here. I'm not an expert in Chinese debt markets, but my understanding is that the way they've treated offshore investors and creditors is significantly inferior to, say, onshore Chinese investors, and I would expect that to continue. It gets back to what I was mentioning earlier in the conversation about, can China get out of this COVID zero funk that it's found itself in, whether they import different vaccines or simply change in stance, right? There was obviously the Xi rumors this past week, but I'll let Alpha, if you want to expound on or add to that.
Well, I think you're right in that China kind of runs a dual money system, right? Like it extends beyond just how they treat foreign investors, right? Obviously the protections for foreign investors are a lot lower than for domestic investors, but they also kind of run a two-level money system. And for a very long time, there was an effort to keep the yuan kind of ring-fenced and isolated within mainland China, in part, right, to help buffer it from fluctuations in the US dollar and other currencies with trade partners, but also, right, to help sort of enhance their internal domestic economic control. So, when you look at things like Evergrande, it's obviously a bad thing anywhere if there's like a massive wealth destruction event, which, if you think about apartments being built that people can't afford and will never live in, like that's obviously a bad thing, and there will be knock-on and contagion effects elsewhere throughout the financial system. But it's not like you have, U.S. banks having major credit exposures against Evergrande to build these apartments, and all of a sudden, if the underlying cash flows that were expected from people taking tenancy in them dry up, they're going to have like a huge hole in the balance sheet of some major bank that's connected to everyone throughout the world. You don't really have that kind of relationship, which is not to say that the problem is completely ring-fenced, but I think you sort of have the Chinese Communist Party sitting in the middle that, is very much trying to play air traffic controller to help limit the fallout, or at least, stop it from spinning out of control, and failing that, limiting who will get hurt. So if you're a foreign investor invested in China, you're probably going to take a loss on, whatever the exposure is. There aren't that many major structural linkages like that, though, throughout the banking system, at least not from what I'm aware of. And this is like as a side note, right? I'm no China expert. And from what I've gathered, most people in the West that pretend to be China experts are really actually pretty ignorant, right? Like the Chinese system is very, very different from the Western one. So, if you're from the West and think like a Westerner and have like a Western financial markets background, and you're giving opinions on China without having spent like years living there, you're probably, maybe close to, but pretty far off of the mark. So it's the kind of thing that like I wouldn't necessarily lose sleep over China and potential fallout from crises in China. But you got to be prepared for that tail risk if there is a major event there that does have effects outside of China.
I just wanted to
Okay.
add one thing related to last week's discussion. We talked about I bonds, and yeah, there was the bill introduced to the U.S. Senate to increase annual maximum purchase on I bonds to $30,000. Right now, it's $10,000 or $15,000 if you overpaid on your taxes. Just wanted to see if anyone had any thoughts on that as well. I do see we have some people in the listening panel that participated last week. I know that when the 10K limit was set, that was probably several years ago, if not over a decade ago. So nowadays, when 10 grand isn't worth what it used to be, it does seem pertinent to adjust it, and I think Rod supports the decision as well. But I'll invite anyone who was here last week to come up and discuss that. I'll invite some of you guys as speakers, and I'll let Rod comment too.
Yeah, we talked a little bit about how there are ways around it, right? It's a $10,000 per entity limit. So there was a great bankrate.com article that kind of lays out, there's different viewpoints depending on who you are. Again, this is not advice, but if you're a little more aggressive, you could have the view that you just need to set up a whole bunch of LLCs in a low cost state, and you can, without even setting up separate EINs for each one, basically just buy as many as you want, right? Obviously, there's other more simple and clear cut ways to get around the individual limit is if you have family members that you can buy it for. There's definitely ways to get more I bonds than 10,000. The question becomes, how much work are you going to put in? Like if you set up 100, again, depending on what your financial situation is, how many individual LLCs are you going to establish to own these I bonds? Is it worth the time and energy for you? It could be, and obviously it is a risk-free type investment that is backed by the U.S. government. You're never going to lose your principal, but yeah, I mean, I certainly support raising the limit. A lot of this stuff is not indexed to inflation, right? I think I see it was 2012 that the limit was set at 10,000 from what I can see. So, in 10 years, that 10,000 is worth a lot less now than it was then. But yeah, I'll pause if anyone else wanted to chime in.
So I have a quick thought on that, and actually have another topic that I'd like to discuss, if that's okay. IBON's great. Like right now, though, they're just a place to park cash effectively, right? Like it's a slightly, well, I won't say it's a slightly better, it's a better yield on cash than having it sit in a savings account or some other kind of, money market equivalent. Right, but given where inflation is, there's not like real investment return on it, right? It's just safety and parity. So, if you can buy them up to the limit that you're comfortable with, but it's not really like a wealth building tool. It's more defensive, which has a place in a portfolio, right? So definitely consider it. But the other thing I did want to talk about, Rod, because I think you hit on something very important for like the folks that are in their 20s now and haven't lived through a bear market, I think it's really important to kind of keep your perspective, right? So like as I'm sitting here now, I have the S&P chart up and I'm looking back to like say the 2008 cycle, as well as what's more interesting to me is sort of the 2013 through 2015 cycle, right? Because what we kind of forget, there was the European sovereign debt crisis happening around then. I guess it really started a few years earlier than that, but Fed was going strong with QE, and you had this period where, when did that really start? Like early 2014 through the end of 2016, where the market, for all intents and purposes, went sideways in a range of about, what is this, like 300 points or so. So not to say that we're heading into that, but like totally agree that the stocks only go up thing is like a phenomenon of really the central bank, right? Infinite liquidity, expanding liquidity forever. The Fed being on the bid in the bond market and tacitly pushing out all those other bids, crowding out investment into stocks and riskier assets. And that situation is actively reversing now, right? So it's really, you got to think about how these things play out and not just like what your experience is, or even looking at the chart. Because if you look at the 2008 chart, it does look like, hey, stocks went down in a straight line, but that really only happened for like 2.5 months, basically, right? So from like August 08 until about November of that year, and then again from Jan of 09 until March, there were only 2 periods of really aggressive drawdowns. And then the rest of the time, it looked like it could have been sideways chop. And when you look at the chart, you don't really get the emotional impact of living through that news cycle, right? So you can like look back and see, okay, stocks fell 20%, and they rallied, another, whatever it was, another 200, 300 points back almost to where the high was. And then you have this cycle where you get whipsawed back and forth, and it's not clear that it's really a bear market until you're at that point where you're going straight down. And you can kind of see that happening now, right? Like the BOE action this week was sort of the same thing where, the major indexes whipsawed like 4% within, 24 hours, basically, down 2%, up 2%, then back down. When you're living through it, it's much harder to keep your focus and like sort of your depth of field. Right. And in general, like even if you have a strategy that will make money, positive expectancy over like a 6-month, 12-month horizon, if you look at the ticker of any given day, it's going to be a coin flip more or less, whether it's up or down. So, figure out what you think, or what your multi-month horizon looks like, and work towards that. Because if you watch the market every single day, especially during times of volatility like now, you will drive yourself absolutely insane. And with that, right, like trying to day trade these small moves, or what look like small moves, you very likely have no edge, and it's just going to hurt you. It's going to hurt your balance. It's going to hurt your mental health. It's really not worth doing or even considering. Just have faith that in the very long run, things go up, and in the medium term here, like there will be more pain to come. Jay Powell has told us that explicitly. So that's my piece.
Well, it's 5:15. We thought we'd run around an hour, and we can field another question or two if anybody wants to chime in. If there's any other topic or comments or questions related to the topics or others, we'd happily field them before we wrap. Might be nice to end on something other than that dour outlook, but to your point, Alpha, when you look back at the max chart of the S&P 500, I think we will look back certainly, and I know I already personally feel this way, and think, oh wow, 2021 was certainly a bubble, and it remains to be seen precisely what where things go, right, in the short, medium, and of course long term. Over decades to come, I think we can safely say that decades from now, the indices will all be higher than they are now. But between now and then, there's certainly going to be ups and downs. And it always gets back to, what is your investment thesis? What is your investment duration? Are you an investor? Are you making a trade? What is it that you're looking to do? And of course, if you're not buying the index, then you have unique idiosyncratic risks with whatever individual company that you're buying that you need to consider and be abreast of. But yeah, any last thoughts or questions? It certainly does smell a little bit like 2007. You know, we're seeing housing. We talked last week about rollover. We are seeing some weird things happening in Forex and in central bank interventions. As we kind of said, unfortunately, it doesn't look like there's a lot of upside risk out there. But if anybody wanted to chime in or add another thought, please don't hesitate to. We certainly don't want to end on a Debbie Downer note, but such may be the reality right now.
I'll just
come on, it's constructive pessimism.
Yeah, that's a better way to say it. I'll just add that there's the Wook Book Club coming up soon. I think in the next few weeks. We haven't picked a date yet, but we're going to host that discussion on the Wook Discord server, which is available for all investors to join. It's wook.gg. The book is Richer, Wiser, Happier: How the World's Greatest Investors Win in Markets and Life. It's fantastic read for all levels, highlights a variety of legendary investors and their stories. So no matter what stage you're at, if you're an intermediate investor, a novice investor, whoever you are, it's a great read. I'm sure plenty of people here have already read it, so we'll just be hosting a discussion on that. One other thing, Rod and I actually talked about this. You earn 3% interest now on Robinhood's, on your balance on Robinhood. So if you're looking for a place, play a little more defensively, have some cash that you can quickly deploy, that's personally where I'm keeping quite a bit of cash, because it's earning a bit of interest, and if I see something I want to pounce on, I can do it without having to withdraw it from any sort of other account and then transfer it, which is pretty high for what is effectively a savings account. So I'll pass it to Rod, closing remarks, and then we'll probably close the stream out for the day.
So since you mentioned the Robinhood thing, I'll just note, you're going to get FDIC coverage on the cash sweep program. It's 3% if you're enrolled in Robinhood Gold, which is $5 a month, right? So you do have to consider that cost. I know I mentioned it last week. There's whether you use Bankrate.com, any other. There's a lot of personal finance apps out there that you can find, risk-free places to put your money if you don't want it to be sitting, in the same account. Obviously, I've learned personally just recently of the ease of buying bonds through Treasury Direct, and then the money's at the U.S. federal government separate account. You don't have to worry that it's like in the same bank, or brokerage account that you might be tempted to tap it with more ease. So there's various more attractive cash options out there. The best I've seen FDIC wise is, with no hoops to jump through, is 3.25%. So that 3% at Robinhood is pretty attractive, even net of the $5 a month fee. And I think that as Fed funds rate continues to rise, right, that's going to happen. You definitely don't want to be leaving your cash, though, at, say, a mega bank in a savings account at your Chase, Bank of America, Citi, Wells Fargo. Those banks have so much more cash than they can lend out. They have no incentive to pay for your deposits because they're so inundated with excess deposits, and they're still paying a couple of basis points. So, we talked about this last week, right? A lot of people and companies may not have realized that with cash rates rising from near zero a year ago to over 3% now, that's not immaterial, and it makes a difference. And certainly once you're talking about larger dollar figures, it adds up. So yeah, we will have the book club sometime mid-October. So we are going to set a date. We'll have that communicated in the next newsletter. And again, Richer, Wiser, Happier. I read it earlier this year. It was an excellent read, and I look forward to having that discussion with you all. I think that philosophy of money is going to make its way into the rotation too. So definitely a lot of good reads, a lot more to come. Again, thanks everybody for bearing with this jury-rigged presentation. Me on the laptop here at my hotel here in Orlando that I just got to. It's very nice to have power, and it's very nice to have air conditioning in Florida. So with that, thanks for joining our second Wook in Review. If you've not yet joined our Wook Discord server, please go to wook.gg and join and introduce yourself. If you haven't yet, we certainly want to have as many perspectives as possible. So thank you everybody for tuning in, and hope you stay safe out there and have a great weekend.